Hello friends, I am Sumit Bhatnagar, Equity Fund Manager with LIC Mutual Fund. Out here I am managing a few active funds, passive funds and arbitrage scheme. I have been associated with LIC Mutual Fund for almost an year now, and my total experience would be almost 20 years in the financial services industry, spread across banks, capital market regulator and mutual fund industry. Today I am going to speak about arbitrage funds. First of all, we need to understand what is an arbitrage. Arbitrage is a simultaneous buy and sell of same commodity in two different markets. Now it is interesting to note here are three components. Number one, simultaneous buying and selling. Number two, same commodity. And number three, in two different markets. Idea is to take advantage of price discrepancy in between the markets and across asset classes. It can be a currency, it can be a commodity or a equity stocks as well. An arbitrage fund tries to generate profits by capturing the price differential in the equity cash market and the futures market. Let's take an example. So there is a stock of ABC Limited trading at say 100 rupees, and the same stock is in future segment is trading at 101 rupees. So we can simultaneously buy the stock at 100 rupees in the cash market and sell the future in 101 rupees, thus capturing 1 rupee spread. Now this stock price can go anywhere. It can move up from 100 rupees to 120 rupees or from 100 rupees to 80 rupees. The fund would capture this 1 rupee spread which we have built. At the time of expiry, futures expiry, which is on the last Thursday of the month, these prices converge and the fund position can be unwound. But that is not the only thing that a fund can do in this in arbitrage fund. If during the month itself the arbitrage spreads converge and there is a better trading opportunity or a better spread available in other stock, the fund manager can exit this stock and enter in another stock, thereby capturing a better returns. This is called churning of the portfolio. This is what arbitrage fund managers try to do in managing the fund. Now, if we look at the fund construct, at least 65% of the fund AUM is invested in equity and equity related instrument, that is equity spot and cash and futures market. Some portion is placed in the form of debt instruments or in the form of liquid fund units or bank FDs for margin money purposes with the exchange, and balance is placed in debt instruments with a view to maintaining some liquidity in the case of redemptions of the fund. One thing to note here is the spreads that we talked about, that is the differential in cash and futures market, keeps on changing depending on the prevailing interest rates in the market, the market sentiment, as also the volatility in the markets. So essentially this 1 rupee spread can either move up or move down depending on the market conditions, and that is also reflected very well in the returns that this category of fund has generated over the period over years, from high of 8 to 9% to a low of 5 to 6%, depending on the market situation as also the prevailing sentiments in the markets. One of the big advantages of this fund is equity taxation. Because we take at least 65% positions in equities, this fund is eligible for equity taxation. Think of it this way, this fund can give you a debt fund type of returns with equity taxation. That is a big USP for this fund, and it can be compared to a liquid fund or a bank FD for investment purposes. An ideal investment horizon for this fund should be greater than 12 months to get bigger advantage of the equity taxation, but at the minimum money should be parked for 3 months. Below that, there is a possibility that return volatility can be high depending on the movement of spreads. At LICMF, we try to churn the portfolio aggressively to capture better spreads and at the same time try to optimize the portfolio construct depending on the spreads prevailing in the market. So to give you an example, if the spreads available are greater than the prevailing interest rates available in the debt instrument, then I would look to increase my exposure from 65% to 70% plus. While if the spreads are in line or lower than debt instruments, then I like to keep my equity exposure at 65%. This fund is an ideal vehicle for someone who is looking to park the funds for 12 months and looking at it as a vehicle for systematic transfer plans into other equity products. Thank you for watching the video.
Investments in the securities market are subject to market risk. Read all the related documents carefully before investing.